Well, welcome to chapter 6. I'll just kind of warn you, it's a little bit longer chapter, quite a bit going on, but it kind of finishes up the corporations topic. We're going to talk about liquidation. So we've kind of spent some time going through the formation of a corporation. Then we talked about dividends of corporations. Now we're talking about redemptions and liquidations. So I think we're primarily focusing on C Corps at this moment in time. And because it's a longer chapter, I'm not going to cover every single topic. I'm just going to let you know there's over 100 slides, and I'm going to go over what I think is important for you to know as you work on the homework for this chapter, for chapter 6. So they always start us out with the big picture concept, and I just want to make sure you read that. Cristina Flores forms Orange Corp 15 years ago. She owns all 10,000 shares. Her basis is 800. She's been a full-time employee since inception. She also earns a salary of 250,000 per year and is, basically handles all management of the company. She's looking to retire. Over the next 5 to 7 years, she would like her children to take over the business, and she'd like to transfer ownership to them. You can see what their ages are right there. They've worked full-time in the business for the last 2 years. They have the capacity and willingness to take over for the business after their mother's retirement. Currently, the stock is worth $12 million. By the time she retires, we're thinking it'll be worth $16 million. It is 80% of her net worth. The corporation E&P is $4 million, generates positive cash flow. Will require, though, some investment in property, plant, and equipment over the next several years. The children are not expected to have financial wherewithal to purchase the stock from their mother at the time of retirement. She would be receptive to taking notes in exchange for her stock. How could a stock redemption be used to assist Cristina in achieving her goal of transferring the stock of Orange to the children upon retirement? And we'll read the chapter to figure out the response. So that's essentially the scenario. Of course, what they usually do is they give us a scenario, and then we have to go through the process of identifying how that will be answered with some possible variations. That's generally what we're going to run into throughout the chapter. So what is a redemption? They begin to talk about that on the bottom of page 2, a little bit on page 3. Is it qualified as a redemption? If qualified as redemption, the shareholder reports gain or loss on surrender of stock. Gain is taxed at a favorable tax rate. Shareholder reduces basis, and capital gains may be offset by capital losses if available. If the transaction has the appearance of a dividend, redemption will not be qualified. So if it's qualified as a capital gain, gain or loss. If it's not qualified, it's treated as a dividend. Shareholder owns 100%, corporation buys half the stock for a certain amount of money, the person still owns 100%. If not qualified as a redemption, the shareholder reports dividend income taxed at the appropriate rates, but redemption proceeds may not be offset by basis in stock surrendered and cannot be offset by capital losses. Corporate shareholders may prefer dividend treatment because a dividend received deductions. So if another corporation is receiving a redemption, they would prefer a dividend treatment because of the DRD, which can be pretty high depending on the percent of ownership. So coming back to the big picture, assume Cristina sells 2,000 shares of Orange to a third party, so not her kids, to a third party for $2.4 million. If the transaction is treated as a sale or exchange, Cristina has a long-term gain of $2,240,000, which is the cash realized minus the basis. Remember, her original basis is $800,000, and so a portion of the basis, 2,000 shares out of the original volume of shares. The original volume of shares that she owns is 10,000, so 1/5 essentially of the basis, 20%. Assume the Orange Corp redeems 2,000 shares of its shares from Cristina for $2.4 million. It's treated as a distribution. As a dividend distribution, a return from the owner's investment. She has $2.4 million of dividend income. after the redemption, she continues to own 100% of shares, who has 8,000 shares instead of 10,000 shares. So just the number of shares goes down if it's a redemption. The following types of distributions are treated as redemption of stock rather than as dividend. The distribution is not essentially equivalent to a dividend or a disproportionate distribution. So there's a subjective test and mechanical rules. It says here then the following types of distributions may be treated as a redemption of stock rather than as a dividend. The distribution and termination of shareholders' interest, mechanical rules, or partial liquidation of a corporation where the shareholder is not a corporation, so it's a person or some other entity. The distribution is not essentially equivalent as to a dividend or an active business is terminated. Then also distributions to pay death taxes. Those may be treated as a redemption of the stock rather than a dividend. Limitation on amount allowed distribution is mechanical test. So stock attribution rules must be applied, so distribution may appear, which appears to be meet requirements may not qualify. So stock attributions, and they begin to kind of go through some of this information here. On page 5, qualified stock redemption must result in substantial reduction in shareholder ownership. And then we've got some rules right here. So these same rules are on page 6. You can see here what those are. Family. Now keep in mind who the family is. It's more direct line. Okay. Spouse, children, grandchildren, parents. Does not include siblings or grandparents, and does not include aunts, uncles, cousins. So it's more direct line on the tree, up and down. You can see a few of the other ones here: partnership, estate or trust, or corporation. Family attribution rules can be waived for redemptions and complete termination of an interest, and stock attribution rules do not apply if partial liquidations or redemptions are used to pay for death taxes. That's a different category. So coming back to the big picture, assume instead that Christina owns only 80% of the stock and the other 20% is owned by her children. For a purpose of the rules, Christina is treated as owning 100% of the stock in orange. She owns 80% directly, and because the family attribution rules, 20% indirectly through her children. Okay, so because that's a direct line, so she owns 100% kind of through attribution rules, but 80% directly, 20% indirectly. Redemption qualifies as a sale or exchange treatment if not essentially equivalent to a dividend, which is a subjective test. The provision was added to deal specifically with redemptions of preferred stock. Shareholders often have no control over when preferred shares are redeemed. Also applies to stock redemptions. To qualify, redemption must result in a meaningful reduction in shareholders' interest in redeeming the corporation. Indicators of a meaningful reduction include a decrease in the redeeming shareholders' voting control, a reduction in rights of redeeming shareholders to share in corporate earnings or receive corporate assets upon liquidation. If the rules are not met for redemption, we treat this as a dividend. The basis in stock redeemed attaches to remaining stock owned. Okay, and then the rules for a disproportionate redemption, and this is on page 7. Shareholder owns less than 80% of the interest owned prior to redemption, and the shareholder owns less than 50% of the total combined voting power in the corporation after redemption. So 80% before, 50% after. So then there's a table on the bottom of page 7, and then there's another one on page 8 that you can take a look at. So the setting here is the shareholder has 60% ownership represented by 60 of 100 outstanding voting shares. And the redemption then transfers 25 voting shares to the corporation. The corporation pays cash and property to shareholder for voting shares. The shareholder then has 46 2/3 to be exactly exact, right? And then you can see that represented by 35 voting shares. So 60 minus 25 out of 75 because you redeemed some shares. The redemption is qualified as disproportionate because the shareholder owns less than 80% of the 60% owned, and the shareholder owns less than 50% of total combined voting power of the corporation. You can also have what they call a complete termination. Termination of entire interest generally qualifies for sale or exchange treatment, often will not qualify as disproportionate. Family attribution rules will not apply if former shareholders no interest for at least 10 years agreed to notify IRS of any disallowed within the 10-year period. Then we have the partial liquidations, and the partial liquidations start on page 9. Non-corporate shareholders get sale or exchange treatment for partial liquidation, including a distribution not essentially equivalent under safe harbor rules, distribution pursuant to termination of an active business. To qualify, the distribution must be made within a taxable year if adopted in the succeeding taxable year, and then requires genuine contraction of business of the corporation. Under the safe harbor rule, to meet complete termination of a business test, the corporation must have 2 or more active trades or businesses that have been in existence for at least 5 years. Okay, so then coming back to the big picture example that we'll keep looking at. Assume that Orange Corp loses a major customer, has a severe drop in sales, so it reduces inventory and has $1.2 million of excess cash on hand as a result. As they sell off inventory that they don't need, it distributes the excess cash to Christina, the owner, in redemption of 10% of her stock. Her ownership interest remains unchanged. She just has fewer shares. It does not qualify as a not essentially equivalent redemption, disproportionate redemption, or a complete termination redemption. Further, the reduction in inventory does not qualify as a general contraction. The distribution is not partial liquidation. Therefore, the $1.2 million is dividend to Christina, and then 80,000 basis in the stock is redeemed and attaches the basis of her remaining shares. So 10% of the business essentially shrank. We mentioned the death taxes item a little bit earlier. Allows sale or exchange if value of stock exceeds 35% of value of adjusted gross estate. Stock of 2 or more corporations may be treated as stock of single corp for 35% test if 20% or more of the corporation owned by the decedent. Special treatment limited to the sum of death taxes and funeral and administrative expenses. And then the basis of stock is stepped up to fair market value on date of death. When redemption price equals stepped up basis, no tax consequence to estate. And then gain or loss recognition. If property other than cash is used for redemption, the corporation recognizes gain on distribution of appreciated property, but loss is not recognized. And that'll come up in the problems too. And that's actually a common theme that we would have seen from previous classes also. And then the redemption effect on E&P. If E&P is reduced on qualified stock redemption by the amount not in excess of the ratable share of E&P, and then also corporate expenditure incurred in stock redemption are not deductible. Accounting, brokerage, legal fees, and so on. And then stock redemptions, no sale exchange treatment. Redemption is not qualifying under previous provisions. It's treated as dividend distribution to the extent of E&P, and attempts by taxpayers to circumvent redemption provisions led to rules covering preferred stock bailouts, which they mentioned a little bit in the chapter, and sales of stock to related corporations. So basically just thinking a corporation that is a related party. They mentioned the preferred stock bailout starting at the bottom of page 12 and also a little bit on page 13. So I'm not going to cover that one. I don't really have much in the homework about that, but I just want you to know it's on pages 12 and 13. Okay, so we will talk about, though I guess I should talk about it just from the perspective of the big picture. I think that's the best way to explain it. Return to the facts of the big picture on page 6.1, assuming that in early January, Orange, with we know their E&P of $4 million, declares and issues a non-taxable preferred stock dividend of 1,000 shares to Christina. After the stock dividend, the fair market value of the stock is 1,080 of preferred share of common stock and 1,200 of preferred stock. 2 days later, Christina sells 1,000 shares of preferred stock to Emily, and a related party for $1,200,000. Section 306 produces the following results. After the distribution and before the sale, preferred stock has a basis of 80. $1.2 million value divided by 12 million value, 12 million value preferred and common, and the basis of 800,000. And the common stock has a new basis of 720. And then Section 306 of the tax code produces the following results. The sale of the preferred stock generates $1.2 million of ordinary income, the amount of dividend income that she'd receive, and preferential tax treatment is applicable to the $1.2 million, so the 0, 10, or 15% rule, or 0, 15, 20, I should say. And then the final slide, the 80,000 basis allocated to the preferred stock is added back to the base of the common stock. So the common stock basis goes back to 800,000, and the E&P is unaffected. Liquidations in general, the company is winding up its affairs, paying off debts, distributing remaining assets to shareholders. So quite often you're selling off assets you don't need and then using that cash to pay off debts. Then extra cash is ultimately distributed back to shareholders. And this is on page 15. Produces sale or exchange treatment to the shareholder. Liquidating the corporation recognized gains and losses upon distribution of assets with exceptions. So the gain or loss is recognized by a corporation on distribution and complete liquidation. Loss may be disallowed or limited if the property distribution to related parties, property distributed as built-in losses, or subsidiaries liquidating distribution to its parent corporation. Property treated as if sold for fair market value. This results in liquidating distribution subject to corporate level gain and then shareholder level tax receipt of the proceeds. Now, there's limitations on losses if it's a related party, and that's kind of one key thing to remember here. And they do mention that on page 17. They're disallowed if distribution is not pro rata. In a pro rata distribution, each shareholder receives their share of the assets. So being not pro rata means somebody's getting more than their share, and the property distributed is disqualified property. Disqualified property is property acquired by a corporation in a Section 351 transaction in the previous 5 years. There's limitations on built-in losses, built-in loss situations. Losses are disallowed when a property distributed was acquired in a Section 351 transaction. And principal purpose was to cause recognition of loss by corporate liquidation. So going back to the big picture and what they call anti-stuffing rules. And again, part of the related party stuff, this is on page 16, is where they discuss this. Assuming that Christina transfers property to Orange Corp in exchange for additional stock, it says the property basis is 100. Fair market value is 55. It qualifies as a Section 351 transfer. Absent any exceptions, the general rule of carryover basis would apply. Orange would take a carryover basis of 100 in the property. Christina would take 100,000 basis in additional stock. And then the sale or liquidation distribution of the property by Orange would result in a $45,000 loss, basis minus the fair market value. So similarly, a sale by Christina of the stock recorded in 351 would result in a $45,000 loss. So this is kind of the flow chart that deals with distribution of lost property liquidation. Just kind of walking you through what the rules are. Again, they kind of begin to talk about the rules on 15, 16, 17, and a little bit on 18 too with the limitations. And then the liquidation's effect on shareholders. This is on page 20. The gain or loss recognized on receipt of property from liquidating corporation. Amount equals fair market value of property received minus basis in the stock, and then generally a capital gain or loss. Basis in assets received in liquidated distribution is the fair market value on date of distribution. And then they go into parent subsidiary situations. I'm going to skip over that, but it's on pages 21, 22, and 23 is where you find most of that. And I'm going to skip this to the section 338. That kind of goes with it. And this is on page 24 and 25. Let's go back to the big picture. You can see here with proper planning, a complete termination of redemption could be utilized to achieve Christina's objectives in the years remaining before her retirement. Christina could ensure that her children are actively involved in the management and strategy decisions of Orange, which so far they kind of have been. Also, an ownership interest in Orange should be shifted to each of the children so that they are in minority shareholder positions by the time she retires. The children could purchase Orange shares from Christina or newly issued shares from Orange itself. Alternatively, she could make gifts of Orange stock to the children. This would eliminate the need for the children to raise capital for a stock purchase and would produce favorable estate tax consequences. Upon her retirement, Orange would redeem her remaining ownership interest, and the two children would be the sole shareholders of the corporation. Assuming that Christina satisfies the requirements of the family attribution waiver, it would basically qualify as a complete termination and redemption. Orange Corp could issue notes to finance the stock redemption and deduct the related interest expense. Christina could use the installment method to report her gain. Now, what if she were to pass away before her retirement date? A redemption to pay death taxes could be utilized to redeem Orange stock from her estate, as it appears that requirements of Section 303 would be satisfied. However, a redemption would qualify under 303 only to the extent of the estate's death taxes and funeral administrative expenses. In the what-if provision, a redemption of an amount greater than the death taxes and funeral administrative expenses probably would not qualify as a stock redemption. After the redemption to pay taxes, the estate's remaining shares of Orange would be distributed to the children and who'd control 100% of the outstanding shares.